So first off, I'd like to welcome everybody and thank everybody for taking time out of this beautiful day outside. So what I'm going to do today is I'm going to give an overview and some comments about the current economic situation in markets. And then I'm going to move into how we've been navigating some of this uncertainty and how we've prepared a lot of you for this realization of what we call a bear market. And then the last bit is I'm going to talk a little bit about what's the last half of the year going to bring us, or might it bring us, and what the data is telling us. So market overview and comments. So I thought I would start. I came across this this joke here that I like, and it's a little blurry. So, on the top part there, it says, I've got a stock here that could really excel. And the next person says, really excel, ? Excel, sell, sell, sell. And we get in this, panic state. And finally, people get fed up and they say, hey, this is madness. I can't take it anymore. Goodbye. Next person says, goodbye, bye, bye, bye. And that's somewhat, I think, where we're at a little bit now. We've had a really good bounce in the market despite the US Fed increasing rates today. That being said, that there's more sellers than buyers right now. And usually during these times, things get pretty darn attractive. So I'll talk a little bit about that as well. So market-wise, market snapshot, just year to date, notwithstanding what's happened today, it hasn't been overly pretty for equity markets to start the year. The S&P 500 has actually posted its worst 6-month start to the year in over 50 years. So if we look at the equity markets, Canadian market has actually been the strongest performing market, notwithstanding its energy and resource concentration. But if we look at, the tech heavy or tech rich NASDAQ, which is at the bottom, it's fallen, 2.5 times more at 24%. And in between, you have the Dow Jones, the S&P 500, and you have the global markets, the MSCI, East Asia, Far East. And what's interesting here as well, I've also included this iShares Core Canadian Universe Bond. So the bond index, or why Canadians own bond generally, is to hedge their risk, hedge their market risks. And what's happened this year is the bond markets are down almost 11%. And over the last 5 years, have actually posted pretty much a zero return. And it's not just equity markets. So we've had people that have said, hey, well, what about commodities? What about gold? Gold's a great hedge for volatility. Well, here's a chart over the last 6 months or so that gold has been in a consistent trend downwards. Okay, year to date, it's fared a little bit better. It's down just under 6%. But overall, it's been on a 5-week losing streak. And so we can see here, it's actually had a fairly substantial reversal from what we saw earlier this year. So some of you have actually seen this slide before. It's called the Buffett ratio. And what it is, it looks at price to earnings for companies, and it compares it to the GDP growth. And we've been talking about this on and off since 2020. As a matter of fact, the first time I started talking about this was actually pre-COVID in January and February of 2020, which was right in this section right here. And what we recognized back then is that this Buffett ratio was close to all-time highs, or highs that we hadn't seen in almost 2 decades. And with COVID, we saw a sharp decline. And then since then, we've actually had a very rapid rise. And then now we've had a reversal of fortune. And when we look at the long-term trend line, even though it's actually come down, this Buffett ratio, and this is something that Warren Buffett looks at when he's buying and selling and interpreting the value of the markets and companies, currently is sitting at 37% higher than the long-term trend line. And that's despite a significant decline here in the last 6 months or so. So from our point of view, when we look at this, we've recognized that this bull market has been 10, 11, 12 years old. And notwithstanding COVID, which was event-driven, we've been preparing portfolios in anticipation of some of this contraction. Okay, we've recognized that companies have gotten, far ahead of themselves. So we've been cautiously optimistic for the last while. So what has occurred? And these, again, nothing is new. These aren't secrets. Obviously, we're going through a high inflation time. We have quicker than expected rate hikes. We have the ongoing geopolitical risks, obviously, in Russia and Ukraine. And then we have the fallout from these events. So China, obviously, they had significant COVID lockdowns that are just starting to ease. And then we have the ongoing sanctions on Russia. And what's happened with this is that we've actually seen commodity prices surge. We've seen, you just go to the grocery store, we've seen just the cost of goods significantly increase here in the short term. And so when we look at inflation, and inflation has been roughly around, the Bank of Canada likes to keep inflation between 2 to 3%, which is what we've seen here over the last, 25 odd years. And we can see this significant uptick again as the fallout of the supply and demand issues. And, if you look at the cost of gas, despite it coming down, it was highly elevated. Okay. So, a lot of people start asking me, they say, hey, well, what do I think is going to happen with inflation? Where do you think it's going to be going? Okay. And if you look at the data, looking at the data is kind of critical, which I'll get to in one sec. The response from central banks, especially here in North America, is to increase interest rates. So the US Fed just hiked today another 75 basis points, or 0.75%. And what's interesting, it's, we've been here before. So here's 2017, 18, 19. We can see rates here in Canada actually increased to a level that we saw just recently. And it wasn't until their last 1% rate hike that we actually finally got ahead of where we were 4 or 5 years ago. And the same, if you look at the US, is the same thing. The only difference is that it was much more gradual. And as a matter of fact, if you look at the US, with the rate hike today, they're almost on par where they were back 5 years ago. Again, what the difference is they're much more aggressive to get ahead of interest rates right now. So back to the comment I made before, what are our thoughts? What do we think is happening? So if you look at U.S. core inflation, U.S. core inflation has actually started to peak out within the last couple months. But this was a chart that was put together by J.P. Morgan, and it looked at a number of different economists and what their forecast was for inflation. And a lot of them, if you look in Q2 and Q3, we can see here for a number of them, they were pegging it to actually kind of plateau or peak. And in Canada, the anticipated inflation number that we were expecting a couple of weeks ago, the number that came in was actually a little bit lower. So I'm not saying that we've actually got over the hump, but things are starting to level out a little bit. And if we look here, and I apologize, it's a little bit blurry here, guys, but again, it's just yet another chart on the data. When we look at what's happened over the last 4 to 5 years, we can see the commodity index. Okay, wheat, flour, gas, all these various commodities. We can see that they've been actually very flat and even actually declined here during COVID. Okay, but what's transpired since then is we've seen a significant increase, which has accelerated here in 2022. And this is really where the peak of inflation has actually come in. But what's transpired in the last few weeks is we're seeing a sharp sell-off on a lot of these commodity prices. So we're starting to see wheat, and we're starting to see gas, and we're starting to see oil. All these various things are coming down significantly, 20, 30%, which is one of the reasons why we're thinking that, we may see inflation peaking a little bit and actually leveling out. Now, the other question I get often is, what about a recession? Are we on the cusp of a recession? The IMF just came out with some revised numbers, and they actually think Q2 in the US will be negative. They've actually been much more conservative. And the definition of a recession is actually 2 negative quarters back to back. So we had negative quarter in the first, or negative in the first, negative GDP, and now we're likely going to get it in Q2. Now, what's important here, guys, is that a recession, a market, it leads us into a recession, okay, meaning that we actually get a lot of headwinds. And it's typically long into that downturn before the data suggests that we've actually officially entered into a recession. Now, the same is true when we exit a recession. And I think I have a chart on this a little bit later. But essentially what happens is when we actually exit a recession, generally the markets are long ahead of it, whereas the recession we're still in full swing of the recession, but markets can rally significantly. So what's really important about, if a recession gets announced, will be how the media interprets it. And generally speaking, the media is all about the rhetoric and getting more subscribers and really driving people on fear. So what's likely going to happen when a recession is announced? We're going to get a big wave of media, a big push, and we might get a little bit of a trend of the markets actually respond to that. But what we have to be aware of as investors, especially mid to long-term investors, is that these market noise, they'll actually balance out. And in 2008 and 2009, we went through the recession while the market started to recover in March of 2009. But the recession wasn't announced until June of 2009, almost a full 3 months later. Well, in that period of time, the markets grew between 35 to 45%, even though we were still in the thick of a recession. Okay, so just keep that in perspective. When you start seeing the rumblings out there about, hey, we're in a recession, keep that in mind. And here's a great example of the headlines. Again, confusing times. So I just pulled these two off that, came out since the beginning of July. And here's the first one. It says the second half is not looking good. Strategists on how to weather the market storm. Well, literally 1 week later, it's actually less than 1 week later, the same media source, CNBC, comes out and says charts suggest the market is poised for an August rebound. So, and again, if you go through it, you can find a lot of these articles with conflicting headlines. So again, try to put out that kind of market noise or the media noise, and let's just focus on what's important, which is good quality investments over the long run. Okay. Now, before I flip to the next slide, some of you might say, well, I don't have the long run. Well, long run doesn't necessarily mean 20 and 30 years. The long run could be the next market cycle, which could be 8 to 10 years. And that's what you tend to look at is bull markets tend to last anywhere between 7 to 8 years. The last bull market was one of the longest on records, whereas a bear market generally lasts anywhere between 8 to 13 months. And that's what we call a cycle. So let's look at that cycle here. So this is a business cycle just in general. And again, it's about perspective, guys. So, regardless of, if you go back historically, the business cycle goes through, very simple standards. It goes through expansion and it goes through contraction. Okay, so we call that peaks and troughs. And what generally happens, it goes up and it goes down and it goes up and down, but the long-term trend is upwards. Okay, if the markets were acted completely normal, so there was no overbuying, there was no overselling, markets would just gradually go up. But what happens is human emotion and human nature, people tend to get greedy and they drive up the shares too high. And then they tend to get fearful and they actually sell at the wrong times. So just going back again, it's all about perspective, time in the market. And I don't want to be talking cliche-ish, but during these periods of uncertainty, it's important to look at the big picture as opposed to getting caught up in the noise. So this chart, and some of you have seen a variation of this chart, but again, a great reminder. So this is the S&P 500, goes over the last 20 years. And how you read this chart is these blue bars, these dark blue bars is what the actual S&P 500 delivered on an annualized basis, okay, in Canadian terms. So as an example, in 2008, okay, the market was down 23% when you factor in the currency exchange, okay? But in 2008, the bottom was as much as 33%. And if you take away the currency factor, it was actually probably closer to the mid 40s. Okay. Well, the very next year in 2009, which was when the bull market started, the S&P 500 started off with another 22% negative return. Okay. But what happened throughout the balance of the year is it clawed back that 22% and added a positive 10. So the market was up 10. But we saw a 32% swing from trough to peak. And the same is true if you actually look at all of these various times. If you actually go here, there's 1, 2, 3, 4 periods over the last 20 years that we've had a negative market, okay, about the end of the year, which means roughly 80% of the times the S&P 500 has returned a zero or a positive return. And we don't know what the back half is going to hold this year. There's definitely going to be some headwinds. Do I think they're going to claw back a full 15%? Possibly. It's what happened in 1970. But, again, it's important to say, hey, these contractions, these corrections, they're part of the normal process when you invest a portion of your money in equities. Okay. And when we look at, from an emotional point of view, when we're buying and selling, this is a great chart because what happens, the way to read this one is, the S&P, this is the TSX this time. The dark blue line goes back again over about the same period, about 22 years. We can see the S&P 500 has gained over those 20 years. But in certain periods of time, obviously it has dips. Okay. Well, what's interesting is when we look at the inflow and outflow of money into the markets, into investments, we can see when it's the worst is generally when people or investors, Canadians, they sell. They make poor decisions. So we can see these bars here, all the outflows of money out of the market. And then when things get good, you see all the money that comes back in. Okay? Now, why this is problematic is simply because what happens is when the market starts to correct, people don't generally get out right here or right here. They tend to get up after riding through the storm after a number of difficult months. And then they get out and the market recovers, but they're not ready to get reinvested. And often what they say is, hey, the markets are going to come back in or down and I'm going to put money back in. But generally what happens is they don't actually start putting money back in until it really gets going. And now what's happened is they've crystallized that loss. So it's difficult sometimes to kind of stay the course, but see your statements the way they are. But the right thing to do is, again, to plan ahead, be proactive, which is what we've done, and essentially weather this storm. We can tweak the portfolios as we go along. And again, it's just a matter of time before we get through these troughs where we start to get extended growth again. So when we look at just the negative returns of the TSX, just to follow up before I move on about how we've been able to position for our clients, when we actually go over a long-term period, when we look at the TSX, over a 7-year holding period, the TSX has never returned a negative period. Okay. But when you start looking over shorter periods of time, monthly, 1 year, 3 year, 5 year, the likelihood of posting a negative year is greater. So again, it's just a good reminder, and this was in my quarterly Challenging the Trend newsletter, is a good reminder that it's the time in the market as opposed to timing the market. And the second one that's below here, this just talks about being fully invested versus missing the best 10 months, the best 5 months, or the best 3 months. So back to my example in 2009, when the markets contracted, we actually had really diligent and pragmatic focused investors and families. And the majority of folks actually hung in there and they had a good result over the long run because of it. I look back, there was, I think, 2 to 3 individuals that actually went to cash at the wrong times. And they were our worst performing clients for a number of years thereafter because they never ever made up that decline that they locked in when they moved to cash. Okay, so again, we're happy to have these conversations. We are looking diligently at, hey, can we make some adjustments? How do we navigate what's going on? But in general, all of our client portfolios are performing exactly as designed, which is to fall less than what the markets are doing. Okay. So let's actually unpack how we've been able to position this. And this is one of the things I talked about in the invite. So how do we navigate the noise and then how do we position? Oh, this is a good one. So this one goes back. So here, market anxiety affects everybody. So there's the queen there, getting a second job at McDonald's. So, all right. So unpacking this. So some of you have seen this. So endowment model, the US super endowment. So what are they doing with their money? So 20 to 25 years ago, they did exactly what we did as retail investors. They bought stocks and bonds, fixed income, and publicly traded equities. Okay. But what's happened over the last 20 years or so, there's been a significant shift away from those more traditional publicly traded equities and fixed income into more alternative investments, which will be categorized as anything that's not a stock or bond. So infrastructure, private real estate, private equity, private debt, and so on. So when we look at some of these biggest endowment plans, Yale, Princeton, Stanford, Harvard, you can see the allocation to alternatives. And generally speaking, when they have the higher allocation, they tend to have stronger risk-adjusted returns. Okay. And some people will say, yeah, but Wes, that's the US. Well, here's the CPP. Okay. 2005, the CPP had roughly 5% allocated to the alternative investment classes. Okay. And you can see this on the side here. Infrastructure, real estate, credit, public equities, private equities, and so on. So 5%. Today, if we actually looked at what they invest in, over 50% of what they allocate is into these alternative or private asset classes. Okay. And so you're looking here, infrastructure, real estate, private equities. They do still have a little bit of fixed income. And by the way, just to comment about that, it's not our favorite asset class, but there's likely going to be a little bit of an opportunity or a trade to actually participate in some of the upside because it's been pulled back so far. But again, it's not something that we're really looking forward to adding into the portfolios because as rates go up, bonds go down. Okay. And here's a good chart. It's an inverse relationship. So if we look at previous Bank of Canada rate hikes and we compare it to an index that actually tracks the bonds, so the core Canadian Universe Bond Index, and I'm sorry if this is a little small, so I'll just speak to it. So if we look at, let's go back in late 05 and 06. So Bank of Canada was hiking interest rates. Okay. And what's essentially happened is you can see the actual bonds so here's the Bank of Canada increasing here's actually the bonds going down. So inverse relationship. Okay. Now, when we go to 2017 and 18, which I showed you on the year-to-year graphs, so it's the same thing. So the Bank of Canada increased their interest rate, and they didn't increase it 166%, but rather from where it was, it doubled, more than doubled, and we're in that position right now. And again, you can see bonds, which again tend to be more conservative, drop 6%. And the reason why is, if all of a sudden you can go to the bank and get 5% on a GIC, well, why would you want to own a bond that's only paying 3%? The only way to sell that bond to somebody else is to significantly discount it to make up for the difference of what you can get on the street today versus what that bond is paying. Okay. So let's unpack the bond index a little bit more. So if we actually look here, the year to date, again, it's come up a little bit because this is about a week old, but again, very small. So I apologize. But year to date, down about 12%. Okay, 3 years, it's posted a negative. What's that? 7%, so over 6%. And over the last 5 years, it's up 1.9. And if we actually look on a compounded basis, ending June 30th, the 1 year is a negative 11, 3 years negative 2, and 5 years a negative 0.07. So this one is a little bit more update. And that's bonds. And that's how most Canadians have 40 to 50%, if not 60% of their portfolio in this asset class right here. So I came across this quote from a fellow Brookfield Asset Management. It's a massive Canadian company here. And what it said is, with inflation running high and the risk of a recession rising, some investors may want to consider alternatives in real estate and infrastructure. Okay. And what he said is, alternatives have strong specific fundamentals as well as fewer investors participating, which means there's not as much market movement simply because of emotions. Okay. Now, the challenge with this type of asset class for most Canadians, they go and buy it on the market. They buy it in publicly traded REITs, which I'm going to talk about in a second. The challenge is that goes up and down with the markets. So retail investors, it's difficult for them to access private REITs. Okay. Now, most of you here on this call actually have access to private real estate. And for most of you, you own the Foresight private real estate portfolio, which is a private REIT, which I'll talk about in a second. But some of you have also owned the U.S. Apartment Limited Partnership, which has done exceptionally well. And as well as some people own Comox Center, which is over on the island. And in every case, even during COVID, even during these periods of time, it's continued to pay out positive returns for our clients. So as opposed to having a traditional fixed income or bond that's consistently trending down, you've just simply used a different asset class to generate consistent and predictable income outside of your publicly traded equities. So let's have a look. So Canada's largest pension plans have been leaders in private real estate. So CPP, I mentioned, Ontario's teacher pension plan, roughly have allocated between 9 to 15% across these large pension plans. When we look at the annualized rate of returns, again, private real estate versus public real estate, very similar, but with lower volatility. And then when we compare that to equities or even Canadian bonds, has been much stronger over the last 15 years. And what's critical, and I think this is often missed, is we look at a lot of things from a risk perspective. So what's the standard deviation of the underlying investment? So just to pause for a sec. So standard deviation, the higher the number, the more volatile it is. Okay. So the lower the number, the more consistent. So when you look at, say, a GIC may have a standard deviation of somewhere between 0.7 to 1%. Okay. The equity markets might have a standard deviation somewhere in the double digits, 12, 13, 14. And everything in between would fall somewhere there. Well, if you look at Canadian private real estate, the standard deviation is 5.3. And when you compare that to the public is 4 times as volatile. But what's interesting is, even though it's 4 times as volatile, the return is marginally better. So why not take 25% of the risk to generate a very similar type of return? So that's how we look at the risk, and that's really important. So again, why private real estate here in Canada? I think there's actually 2 to 3 different reasons, actually. One is immigration. So we have significant amount of individuals that are coming into the country, which again, there's probably more people coming in than what is being built. So that demand is there. The second one is that we're seeing the younger generation, they don't want to get saddled with a mortgage. So a lot of them are renting. And that's their preference. They want to They want to have the flexibility to jump on a plane or go travel or what have you. It's just lifestyle. So a lot of them are renting versus buying. And I'll give you a really quick example. You know, we have somebody here at our firm that just recently got into a new a rental property in Port Moody. So it's not like it was done 6 months ago. It was within the last 2 weeks. The rent was $2,700 a month, and there were 16 applicants for it. Okay, so the demand is significantly high, and with people coming in, it's just going to get even more. So number one is immigration. Number two is the younger generation. And the third one is we have a lot of retirees that have actually downsized, maybe sold their house, and they've actually chosen to rent. And I read a recent report that said those that are renting right now have no ambition to actually get back in the real estate market at this point. So again, there's a lot of demand for rental properties, income properties, which again, will be a positive for private real estate. And then inflation. So inflation, this is top of mind. So real estate, people are saying, hey, how's it going to work with inflation? Generally speaking, if we look over the last, 35 years, you know, this report shows periods of low GDP growth, medium and high GDP growth, meaning high GDP, things are really moving. Low GDP means the economy is contracting. But if we actually look at the returns, they've all been very consistent. They've been lower in low times, higher in high times, but in general have provided a very good negative correlation to equity markets. Because generally in low GDP growth, it means volatility has crept in the markets, and we actually see more of a decline over those periods of time. So you might be saying, well, what part of the real estate market should I actually be involved in? Which is a great question. Okay. So when we look from an asset class point of view, on the right-hand side, we can look at the equity markets here. So you have Canadian equities, US, global, and emerging markets. Well, if you look, it's all average. Most of them over the long term have averaged, 10 to 13% on the more risky side on emerging markets. Okay. But to actually generate those returns, investors have to stomach, decent returns and then really significant declines. Well, if we look on the left side over here, we have multi-residential properties, retail, office, industrial, commercial. Well, they all generate a very similar type of return, but with lower risk. You don't see the big drawdowns like you do with the equity markets. And if you focus on the multi-residential property, which is this orange one or yellow, depending what you're seeing, the drawdown hasn't had any negative drawdown. Okay. And the upside hasn't been as high as the equity markets, but the annualized rate of return on it has been roughly 10.5%. So these would be multifamily. So you think apartment buildings, condo building, multiple doors. Okay. So, and you might be saying, hey, Wes, but real estate is projected to have a significant contraction. So sales are likely going to drop pretty significantly. We've already seen it. And residential properties will likely go through a correction, and what they're paying is maybe a 10 to 15% correction, but we're not quite sure. But when you look at these income generating properties, they're valued a little bit different. It's about the business revenue. So the revenue they receive, and that's how they actually get valued. So when you have a condo building where you have, 100 doors that people are paying rent on, again, it's just insulated a little bit different because it's creating income for somebody that owns that building. So here's the publicly traded REITs. So this is a REIT. So a lot of Canadians will go buy a REIT. So RioCan, Chartwell Residences. There's several of them that, you can go and buy the shares of a company that has several properties across Canada. The problem is because it trades on the TSX. So this is COVID. We can see here that the publicly traded REITs, okay, even though they actually continue to own the properties, a lot of those tenants continue to pay rent, their share price went down 50%. And then we can see here in 2022, same thing. So it took almost 2 years to claw their way back. There were the REITs, the publicly traded REITs, to claw their way back to the pre-pandemic levels, only to see it go the opposite way again. And so we've seen a fairly significant decline again this year. Well, private REITs, and I'll give you a couple examples, private REITs don't actually go through the same volatility. Okay. So here's just a couple. So here's one. It's an apartment REIT. This is part of that Foresight pool. Here's one where this investment through the company in Ontario, there's 234 properties as part of this investment across 7 provinces. And there's 21,000 doors, 21,000 units for people to rent. And the occupancy rate on it is 97%. So you almost have full buildings. Okay. And they never get to 100% occupancy, only because there's always people moving and coming back in and so on. So here's again a very well diversified, large real or apartment building investment that is average, in the double digits over the last, and this goes back to 2006. Okay. Now this is a commercial REIT. This is a commercial REIT with the same thing. It's the same company, commercial REIT. But again, here's 82 properties, almost 98% occupancy with an average lease term of 7.5% or 7.5 years. Okay. And same thing, this goes back to 2012, so almost 10 years old. And again, pretty strong results. Now we don't invest directly in these. We can, but for a lot of times they're closed. We can't actually invest, more money into them. Just because these companies say, no, we actually want to close the new money. We want to just manage our existing investments, number one. And number two, a lot of these might not be RSP eligible. And most Canadians actually build their wealth in registered plans, whether it's locked-in plans, RSPs, TFSAs. And then the third one, a lot of times, is they have high minimums. So in order to actually get in here, you might have to put 50,000 or 20 or 100,000 into just one investment. And the problem, the average Canadian doesn't have enough money to actually service or to add that many of these individual holdings to truly diversify their approach. Okay, so if somebody wanted to put $250,000 of their portfolio into these investments, they might only buy 5. But again, if you can access them where they're all wrapped together and get access to 15 in one investment, plus it drives down the actual minimum investments, then a lot of Canadians can access these with as little as 50,000 for 15 of them. Okay. And here's another one. So this is one that has 102 properties, okay, 15,000 rental units across 33 cities, both in Canada and the US. And it has multi-residential apartments, student communities, medical offices. So student communities would be, buildings in and around universities and colleges. Okay. And if we look at the risk of this, here's the equity markets. Okay. Here's the actual risk of this private REIT. So significantly lower. We're coming just over 4% versus double digits here. But the returns have been much stronger than even a lot of these equity investments. So the benefit is actually we're getting equity-like returns with a fraction of the risk. Okay. So there's just a few suggestions or what we've done for you that maybe you don't recall. So it's always good to go back and say, hey, here's how we've actually managed to generate some revenue or some growth with more conservative investments within your portfolio. Now, I don't want to leave equities out. Okay. So equities, it's important to talk about. So we like dividend, obviously producing investments. Dividends are much more tax preferred than interest bearing investments, or we try and do it with capital gains. So here's an example of in every decade since the 1950s, how dividends affected the overall returns of the S&P 500. So I'm going to focus on the 1970s. And the reason I'm doing that is that's a period of, it was high inflation and kind of stagflation and rising interest rates. So even though it was a really challenging year or a decade for the S&P 500, the annualized rate of return on that was still 5.8%. But what's interesting is it didn't come much from capital appreciation, but rather it came from dividends. Okay. Now dividends have tracked down over the years. You can see now, the average dividend on the US or the S&P 500 is much lower than where it was before, but we've been getting more capital appreciation. Okay. So again, we're fans of dividends, and the most, probably the most famous ones, I think, would be on the Canadian side, which is our Canadian banks. They're all paying between 4 to 6% right now. Okay. And when we do talk about equities, again, just kind of putting it in perspective. And guys, I'm going to talk for about another 10 minutes before I answer a couple of questions here. What tends to happen in markets like this is the stock prices tend to get ahead of the earning reports. So what I mean by that, if we look at 2022, this was as of July 22nd, we can actually see the price of equities are actually down. They've declined. Okay. But the yellow bar here, that's the actual corporate earnings of what's been reported and the actual decline of corporate earnings versus previous years. So what's interesting is we can see in the markets currently, the price has been affected based on what we think the future earnings are going to be. Okay. The earnings actually haven't been reported. The markets have come down because we think there's going to be an economic slowdown and therefore companies will be less profitable. And because the markets are always forward looking, that slowdown in the profits get priced in today. And a good example of another way of looking at this is when the US Fed or the Bank of Canada are going to hike rates, generally what happens is the markets don't respond when they announce, but rather they price it in with the expectation of what they're going to announce. So if we think they're going to do a 0.5 point increase, then the markets price that in. Okay. So if we go back over, the 1990s, 98, .com and so on, we can see in a lot of cases where we're at today in terms of the price decline of stocks are very similar to a lot of these other ones. Okay. Now we're just waiting for the earnings to see if they're going to be as negative as what is priced in the market currently. And what's interesting, a lot of US companies, a lot of big US companies have actually started to report. So 60% have beaten, whereas 75% have actually stayed the course, have actually reported what they've anticipated they're going to be at. Okay, so it's actually quite positive thus far. 75% of companies that are reporting have either met or exceeded expectations. Okay, now just before I jump onto the last little bit, I thought I would just provide some quick statistics here. Okay, so bear with me as I read the paper. So Google and Microsoft, they both announced yesterday, to put it in perspective. Okay, so Google was down 4% yesterday, and Microsoft was down roughly the same. So they made $52 billion. Microsoft made $52 billion in revenue. Okay, with a B, billion. Okay, Google reported close to $70 billion of revenue. But because they didn't actually make a little bit more, the stock went down. Okay, so let me just say that again. They thought Google was going to actually make $69.8 billion last quarter. It only made 69.68. And because of that, their stock went down. Okay. They have free cash flow in the bank of close to $70 billion. Microsoft, on the flip side, has roughly $64 billion in the bank. They had, again, reported revenue of close to $52 billion, and it pays a 1% dividend yield. Yet it's down, both of these companies are down 20 to 30% this year. So it's not that they're not profitable. It's not that they're not making money. It's just they're not making as much money as what they have in previous quarters. That's the reason why they go down. If I said to you, if I was having a conversation, I said, hey, what are your thoughts about investing in a company that makes $70 billion a quarter, that has $70 billion in cash, and it pays a dividend? Most people would jump all over that, okay? Because that is a very profitable, successful company. Unfortunately, the expectation is what drives the price, okay? So let's jump into the second half of the 2022 and what we're thinking about right now. And listen, before I get into it, I'm not trying to sit here and say everything is going to be rosy, because we really don't know what tomorrow holds. We think there's going to be some headwinds, but we also think some of the data we're starting to work through some of that data. And we're in a healthier place today, despite all the noise, than where we were 6 months ago. Okay. Bank of Canada has had significant increases. US Fed has had significant increases. From a Canadian point of view, their target interest rate is roughly 3.5%. We still have about 1% to go to get there. So I would anticipate that we're going to have at least another 1% in rate hikes. Whether they do it over 1, 2, or 3 periods, I wouldn't be surprised if we get there, because that's their goal. They want to get ahead of inflation. Okay. So when it happens, just say, yeah, this is kind of par for the course. This is what we were expecting. It's the worst kept secret in Canada that they were increasing interest rates. So we just want to keep that in perspective. Okay. So we'll start with this. So, our good friend Warren Buffett, one of his great sayings is be fearful when others are greedy and be greedy when others are fearful. So you've seen, you've likely read or seen a lot of his comments in the news recently, where he's been deploying money. He's been buying companies. He did this in 2008. He buys when other people are selling. Okay. So I thought this was an interesting chart where it talks about global growth optimism falls to an all-time low. So we can see here, we are here. Okay. This is the Bank of America. This is a survey here. It hasn't been this low since October of 2008. Okay. We touched on it in 18. We touched on it in 20, but here we are today. So we're getting to the point now where individuals or companies or outlooks are so bearish that we're going to start seeing more buyers. People are going to start taking advantage. I talked about Microsoft and Google. They're going to face some headwinds with rising rates because growth companies tend to do that. But that being said, they're going to get to a point where people are going to say, hey, it's just so darn attractive. I got to start buying. And it's going to be the same in real estate. If all of a sudden real estate goes down 20 or 30%, hopefully it doesn't, but let's say it did, even if you weren't looking for a rental property, you might all of a sudden look and say, hey, it's just so cheap. I think it's time for me to start buying. Okay, same thing with equities. So I mentioned 1970 a few times today. So 1970 was the last period of time where the S&P 500 had just as bad of a year, first half of the year, as what we've seen this year. Okay, and so mid-year, here's where it was. Here was the S&P 500, it was right in here. Okay, first 6 months of 1970, kind of mirroring here. Well, here's the last 6 months of the year in 1970. So, and I'm not trying to say, hey, it's going to be the same as 1970, but I'll tell you, a lot of people probably felt pretty pessimistic in this period of time, only to see a fairly significant upside. And we've seen that in July. June was one of the worst months the S&P 500 and markets have posted in decades. And here we are in July, that I think by time the end of the week hits, we're going to likely see a positive year or a positive month, despite all the noise that we've actually gone through this month. So here's another one. This is the Fear and Greed Index. And I've shown this one once before. What's interesting, if you looked a year ago, this Fear and Greed Index that looks at 7 different factors, a year ago would have been neutral. And so what I've done with this one is I'm illustrating what it looked like in May 9th, in comparison to July 24th. And this is something that CNN puts out together. So as little as 6 weeks ago, the noise around this Fear and Greed Index was off the charts. Everything was extreme fear. The world was ending, panic was setting in. Nobody saw good in the markets or the economy. Well, 6 weeks later, we can see it starting to trend back the other way. And can it go back this way? It absolutely can. But again, people are starting to digest from an economic point of view. They're starting to see some of this data level out, and they're saying, hey, I'm not so fearful. I'm still cautious, but I'm not so fearful as what I was as recent as 6 weeks previous. Okay? And this is just if you look at the chart. So this goes back over the last, year and a bit. We can see here, even over the last, since May, we can see that the sentiment from the overall fear is actually trending upwards. So things are actually starting to improve here. Okay. And then I have three last slides here, guys. So just, again, put it in perspective. So how are we positioning it? So, we look at where the bear market is. Okay. And bear markets generally last roughly on average 7 months, 11 to 7 months. Okay. The average is 11. The median is 7.2. We're 5.5 months into this. So you could argue that we're almost halfway through it, if not near the end of it. And I don't know if I would put all my eggs in that analysis, but again, it's important to say, hey, because we're getting closer to it and we're looking at the companies that are trading out there, we want to try and take advantage of some of these companies that are on sale. So again, if we go historically back over the last 65 years, this shows all the various bear markets in the past and how long it's been. Okay. And so again, we think we're on the back half of this here, and we're looking for data that is actually supporting that. So for the time being, we're going to continue to be cautiously optimistic. We're going to be continuing to make sure we have these alternative investments that are providing good, consistent, predictable yields. But we also want to start to try and take advantage of some of this pullback. And the reason, again, if we go back, and this is a good chart here, the bull versus the bear, and again, our rationale or thinking, well, this goes back almost 100 years to the 1920s. And what's important on this graph is these little yellow bars or orange kind of declines you see here. These are the bear markets. Okay. Now, what's interesting is when markets go through these shorter contractions, it's followed by sustained growth. So in some of these cases, the most recent bull market was almost, notwithstanding what happened in COVID, was close to 12 years. Okay. So, when we do get through this, if we are on the backside of it, the next leg up will likely be significant, and it will likely go for 5 to 7 years. And there will be some peaks and valleys. You can see that in any of these bull markets, there's these little peaks like we go through. But in general, before it goes through a contraction of 20%, okay, we get some significant growth during those bull markets. And the other thing that I actually find interesting with this graph, because again, it goes back to my recession comment earlier, is if we look at these gray bars, you can see them, they happen every few years. Okay. Here's one where it went an extended period of time with no recession, but these gray bars signify the recessions. Well, check this out. In a lot of cases, guys, these recessions, they're happening during rising markets or right at the beginning of rising markets. So when that recession does come out, and I said it before, and unfortunately, I didn't include the graph, but in 2009, from the start of the bull market to the time they officially announced the upside or the ending of the recession, the markets gained 35 to 45% in North America. So before we know it, again, the market might book in a very healthy upside before the economy is in the clear and out of the recession. And then this is my last one. Okay, so this is my last one. Again, we go back, and then I'll kind of summarize here. So this is the S&P 500, the year-end target. So we see a lot of really large names here. We see JP Morgan, we see BMO, we see Deutsche Bank, Barclays, RBC, Citi, Morgan Stanley, Bank of America. So a lot of them actually have higher targets than where we're sitting today. There's actually only 2 financial institutions that actually have the S&P 500 tracking to be lower than where it's currently sitting as of July 25th. So every single one of them, other one, has it up anywhere between 7 to, I don't think the 4,900 is probably realistic, but we could still be 10 to 15% upside from where we are today by the end of the year. Okay. Now, is that my prediction? It isn't, but I think it's important to be realistic and be very practical about what's happening right now. So, one of the things I said is, hey, how do we navigate this back half of the year? So again, even though that we're in situations where we're fully invested, we can still tweak the portfolio. I mentioned earlier tech companies, Amazon, Google, Microsoft, they're all down significantly. Apple's another one. Now, do I suggest everybody runs out and buys tech companies? I don't. But should everybody have some of those large mega cap companies that are going to weather the storm over the long run in their portfolio? Somehow, whether that's through an S&P 500 investment, whether it's through a sub-advised investment, whether it's through individual holdings, but they should have some exposure. Do I think they should have dividend stocks? I absolutely do. Okay. So we couple those good quality stocks, which is what we've been doing all along. We look for opportunities and we couple that with some of these more defensive investments that actually will still give good returns, because most people here shouldn't be 100% equities. They don't have the time frame or the stomach to actually see a correction of 20, 30% at some point in their lifetime. Okay. So we want to actually, insulate that. And when we look at, the last 18 months, the majority of individuals have posted positive decline still, or positive returns still, despite the fact that the markets are down so much this year. So again, we just want to stay focused. We want to make sure that we actually have everything pointed in the right direction, and we can make tweaks along the way. Okay. So I'm going to pause there. Like I said, I've spoke for the last 45 minutes or so. It was a little longer than what I was anticipating, but I think it was all really good information. What I'm going to do is I've had some questions come in. Like I said, if you'd like to ask some questions, please put it into the Q&A box, which is at the bottom. Like I said, I've already had a few come in, and I'll just answer some. In the meantime, feel free to type away. Or the other thing you could do, there's my email. You're more than welcome just to type it out, put it right in email, and I will get back to you over the next day or so with any comments if you have questions. Okay. So first off, so the first question I have is, retirement is on our mind. How does the current market environment impact those planning on retiring? And I think that's a great question. Retirement comes with a lot of anxiety. All right. Notwithstanding just the change between working to all of a sudden no longer working, but also from a financial point of view. You've worked all these years where you get a regular check every 2 weeks. Now all of a sudden you have to depend on your investments. Okay. And from a portfolio point of view, I would encourage people to still retire. This is going to be one kind of small period of time, in amongst, 10, 20, 30 years for people. And a lot of people have heard me say, we all have to plan for tomorrow, but we have to live for today, because tomorrow is just not guaranteed. So if you are planning to retire, we've probably already had these conversations, but if this is something that's more in your mind today than what it was in the past, I would suggest, connecting with us. Let's have that conversation. Let's put your mind at ease a little bit, because again, there's a lot of ways to generate some cash flow in the short term. As I mentioned before, we will get over the hump here and start to see, growth again in the markets like we've seen in previous years. So it's just navigating it here in the short term. And again, there's a number of different ways to be creative to draw money out without impacting or crystallizing a decline in the short term. Okay. All right. The next question I have here. Good question. So I have one here on real estate. So it says, my kids are wanting to get into real estate. How does the affordability of houses and rising interest rates affect them? A very good question. So the benefit of rising rates in a cooling real estate market is that houses will become more affordable. And we're seeing that already. The trade-off, unfortunately, is that the borrowing costs are going up. So I saw a statistic on TV maybe about 2 weeks ago, and they said, hey, if at the beginning of the year, somebody wanted to qualify for a $500,000 mortgage based on interest rates at the beginning of the year, today, and this is before the Bank of Canada hiked 1%, they could only qualify for a mortgage of roughly $400,000. So the challenge with it is that banks are quite conservative, And so for a lot of situations, and again, this is another question I happen to see on here, people are asking about gifting or helping their kids, the bank of mom and dad, and that's something that, and again, ties into the retirement piece too. I'm a parent, most people on this call know that I have a young daughter, and we all want to help our kids. Okay. But at the same time, we also have to make sure that we're not impacting your retirement objectives. So we don't want to see you give money away and sacrifice what you guys have worked really hard for. And again, if you do, that's your choice. So it's really important that, if you are going to gift and you are going to help, let's make sure that we do it prudently and we do the calculations, number one. Number two, if you are going to help them out, let's make sure we document it in the proper way so that you protect your family assets as well. And it doesn't mean that you have to give it to them as a mortgage or what have you, but you really want to protect it. For whatever reason, you gift it to one of your children and they have they're in a relationship, and that relationship, dissolves. You don't want to be in a position where half of that gift, goes out the door with that ex a partner, ex girlfriend, boyfriend, husband, wife, or what have you. Okay. So again, bank your mom and dad. Yeah. Again, a lot of people are doing it. They want to gift with warm hands as opposed to cold hands. But in general, we just want to make sure to see you guys doing it prudently. Okay. Okay. Let me just have one last one and one last look. Here's the one last good question here. So somebody here has written, should I borrow to take advantage of the markets? How can I take advantage even if I'm fully invested? And this is a great question. Generally speaking, I'm not I wouldn't suggest that everybody runs out and accesses cash to put into the market. But in 2008, we definitely had folks that said, hey, how can I take advantage of this? So some people did actually borrow to put actually money into the markets. It's not suitable for everybody. Obviously you need to do it extremely prudently. You want to have a good experience with it, but that's one aspect. And then that interest becomes tax deductible. But again, not for everybody. So the second thing is they say, hey, well, I'm already invested. How do I take advantage of it? I don't have cash. I can't, somehow get reinvested. The benefit for us when we're actually looking at the portfolio, we can still take advantage of it without having to have cash. So what we can do is we can actually have the portfolio. We can actually make some adjustments in the portfolio, and maybe we rotate out of certain sectors. So maybe we go from, maybe we go from utilities or healthcare or something that maybe doesn't have as much of a upside growth, and we can move that into some of different sectors that actually might be beat up a little bit more. So essentially what we do is we just rotate the existing portfolio. Okay. And the benefit is we can actually get the exposure, the key exposure of what we're looking for. Okay. Okay. It's a good, I'll actually just ask one more question here. So somebody actually had it here. If private real estate has such a high return with so little risk, why not put the whole nest egg in private real estate? It's a good point. We do have some people that do actually put their whole nest egg in retirement. It's not something that we would do. In general, it's not something we'd suggest because, again, we always like to just diversify. We recognize every asset class goes through peaks and valleys. real estate will be very consistent and predictable. But if all of a sudden, even if it slows a little bit and it's still a good investment, we all of a sudden might have equities highly outpace it. So if we actually put the whole nest egg in private real estate, you're going to actually miss out on the other side. So I think it's really important to make sure we have a properly designed investment strategy that's suitable for each individual that we're looking for. And we try and tap into multiple asset classes. It's no different than big pension plans. They don't take all their eggs and put it in real estate. They do have 10, 12, 15%, but they also own infrastructure and public equities and fixed income. So they spread that risk, which I think is actually really important. Okay. Okay, last one here, guys, and then I'm going to let people go. Please keep on sending me emails. I have a lot of questions here. I apologize that I can't get to everybody. This one here says, hey, we're planning renovations prior to selling the house. We have the cash on hand, but is it wiser to take a line of credit and pay off when the house is sold? Very good point. If you happen to have cash on hand, is it wiser to take a line of credit? If the line of credit is 5-6%, it might make more sense to use the cash because you're saving that 5 to 6%. What I would actually look at is what's your time frame on the renovations. If the renovations are going to be 6 to 12 months because it's really difficult to get trades, then you might want to get that cash working for you and draw it down over time. Okay. But again, it's really situational. If I were to, again, there's no name on this one, but if somebody were to email me and say, yeah, I'd like to talk about this a little bit more, it does really depend on the situation. Some people don't like to have a line of credit or they don't like to have it at these levels. So again, some people will take a line of credit, some people will use cash, some will do a combination. But at the end of the day, you want to make sure to be as efficient as possible with that cash. You don't want to be sitting around earning next to nothing because inflation right now is between 8 and 9%. So we need to get something on it. Okay. So listen, folks, I'm going to sign off. I've been chatting for about 60 minutes here. A couple things just as a reminder. We're going to send a survey out to kind of get your feedback on what you'd like to see on these future webinars. I think it's really important that we do these on a regular basis. We're going to commit to start doing them on a quarterly basis next year. But this year, given the fluidity of the markets, we're going to do one in about 6 weeks, probably mid to late September, and then about another 5 to 6 weeks thereafter in November. Okay. And so with this survey, we'll get an idea of what you guys are looking for. We'll still give a market update. We'll still give an idea on what's happening with inflation and from an economic point of view. But as well, we can tie in maybe some tax planning, or some retirement questions or what have you. Just provide a little bit more value than just market related. So, folks, if I don't speak to you in the next couple of weeks, enjoy summer. Stay cool. Be safe. If anybody has questions, my door is always open. Please give me a call, send me an email. We're good at getting back to you guys. But again, be well, and we'll talk to everybody soon. Take care. Bye now.